Good morning, good afternoon, good evening, everyone, and thank you so much for joining us today on this webinar focused on climate risk mitigation for commercial real estate. We have a wonderful panel joining us today, and we'll do full introductions in a moment. But before we get going on the actual panel, would like to hit some housekeeping issues first. First, please do mute your microphones. We will have opportunity for you to unmute and ask questions later. If you need for accessibility, we have the closed captioning function and you can turn that on as you needed. Also, we will be recording this webinar. So we will be providing that link after the webinar for you to join, or if you missed something or have to drop early, we certainly will want you to go back and to rewatch the webinar at a later point. And finally, we have a very robust question and answer period. Please do put your questions in the Zoom Q&A box, and then we will be combing through that at the end of the webinar. We'll be leaving approximately 10 minutes at the end for you to get your questions answered. And so with that, let's get us kicked off. So my name is Andrea Pinabell. I'm the Vice President of Growth and Innovation for RETEC Advisors. RETEC is a women-led sustainability advisory firm that designs and implements award-winning programs to improve sustainability and your financial performance. We have a robust interdisciplinary team that creates customized solutions that unlock your value, fulfill your investment and fiduciary objectives, and pioneer the transition to a low carbon economy. And RETEC, we are one of the business units of Legence, which is the world's first energy transition accelerator. So we're so pleased that you are here today. And with that, let's get us kicked off. So I wanted to start today by sort of level setting what we mean by climate risk. So climate risk in real estate is the potential damage to property and infrastructure caused by climate change. It can both have physical and operational impacts on real estate assets and can also affect a property's value and market position. So what do we mean by types of risk? So there's really two types of risk. There's acute risk, which are short-term and includes like extreme weather events like storms, floods, wildfires, landslides, and extreme snowfall events. It can also be more chronic or long-term, which include gradual changes like rising sea level, drought, heat waves, water scarcity, or food security issues. Next slide, please. This is, I think, a very fascinating, but it tells a story of where we are today. So this is a graph. The one on the left is temperature differences versus a reference event for the last 10 years from 1850 all the way up to 2018, and then the weather global insurance losses. So you can see as the temperatures are rising, the global insurance losses are also rising. Real estate investments often use this 10-year time horizon, but insurance is repriced every year. So what that means is that recent and projected increases in these insurance premiums have also increased deductibles and the reduction in coverage and availability. I know many of you have seen the issues happening in Florida and California and other places around the world where full insurance companies are pulling out of regions or states or areas that are seeing many of these both acute and chronic climate-related issues. In fact, there were 17 bankruptcies of insurance companies in 2023, which is an all-time high because of these increased losses. And on average, globally, weather-related property losses in excess of $1 billion occur now occur only every 18 days. And a decade ago, it was every 82 days. And so if you think about the tremendous more billion-dollar loss days that we're having today versus a decade ago, really begs the question of like, what is happening and how, as commercial real estate asset owners, investors, and partners, how do we deal with these? How do we protect our assets? And then what can we do in order to help to mitigate this risk as time moves on? And so with that, I will move into panelists. So what I'm going to do is I'm going to briefly introduce each of our panelists. And then they're going to introduce themselves and then answer this question. In the current market, do you see businesses focusing on physical risk more or transition risk more? Oh, I'm sorry. I jumped ahead a question. Let me back up for a second. In your current day-to-day work, how do you see climate risk impact your organization and the work you do? So we'll start with Adam. So Adam is the managing director and head of ESG Real Estate Americas for JP Morgan Asset Management. He is located in California. So Adam, I'll just turn it over to you.
Thanks, Andrea. Great to be here. Briefly, my background, traditional real estate pathway. I detoured to help start Greenprint, which is now part of Urban Land Institute. Spent about a decade at Hines and now at JP Morgan. So in terms of the question you asked, which is the day-to-day, so I would say climate is one of our priorities. You can step back and look at JP Morgan, the large financial institution, and climate plays a big role both in our risk management platform and also products that we offer for various types of investors. From a risk management perspective, which is really where my team plays a role, we actually have climate scientists in-house at JP Morgan. We take all kinds of data and CAT models and combine it all to really try to create a resilient portfolio, both throughout the bank. So you can imagine the thousands of Chase Bank branches, our new sustainable headquarters in New York City, throughout the dozens and dozens of countries in which we do business, and then also within our investment portfolio. On behalf of our fiduciaries, and that's really the perspective we take, climate risk is something we need to manage. There's ways to mitigate it, there's ways to adapt to it, there's ways to underwrite it. And so that's really been the focus of where we are day to day. And I'll just add, we do have a pretty robust TCFD report. So that's publicly out there. And if anyone's interested, you can read all 50 pages of everything we do day to day on climate and transition risk.
Thanks, Adam. Next, we move to Brian. Brian Seaman, he's the managing director and head of asset management for New York Life Investors. Brian?
Yeah, thanks, Andrea. Glad to be here. We have to up our game. We don't have any scientists in-house like JP Morgan. So I am out in San Francisco as well, in California, and I oversee the asset management team nationally, as well as lead our sustainability effort on the equity real estate side. Now, you might ask, why am I here? I'm just a simple real estate guy, and I think I can lend a perspective from, again, from the pure real estate perspective, not from the ESG perspective entirely. So we manage money, and I'm going to speak today from the real estate perspective, not from the New York Life company perspective. And we manage money for the balance sheet as well as for third-party clients. And we're fiduciary on total return funds, not ESG funds. And thankfully, I have some really smart people back in New York that work with me on the ESG front. So as to the question on how climate risk impacts our organization, I'll say three main things. How can we control the risk narrative? How these risks, climate risks, are perceived, communicated, and managed. And listen, you're better off having an answer and a plan than not. Imagine being in the elevator with your CEO and ask, hey, what are you doing about transition risk? Or what's going on with this climate risk I'm hearing about? And if you don't have an answer or plan, you're going to be in trouble. Second thing, protecting asset values. Thankfully, with folks like RETEC, they can help us identify these risks and mitigants to offset those risks. Every investment we look at has to have an acceptable, risk return profile. Back in the day before we looked at climate risk, we looked at environmental matters. You get a phase one, and we wouldn't simply walk away because, let's say, it's dirty dirt. We figure out what it costs to fix that, and if the investment still makes sense, we move forward. Same thing with climate risk, in my perspective. Lastly, from a larger perspective, how can we limit fund exposure beyond just simple property exposure, but fund exposure to these various risks?
Great. Thank you, Brian. And finally, but certainly not least, Emma Hughes. Emma is our very own Director of Climate Risk Solutions here at RETEC. Emma?
So much, Andrea. Nice to see everybody. I've been with RETEC about 3 years. I lead a team of amazing consultants on the climate risk solutions team. Our organization works with asset managers, asset owners, institutional investors, corporates, private equity firms, basically anyone that happens to own, operate, or invest in a large commercial real estate portfolio and footprint, can confidently say that climate risk is having a massive impact, not just in the way that we work with our customers, but in the way that we evolve our service offerings. Certainly seeing across RETEC's client portfolio an increased interest in climate risk management services. What this really means is providing support to folks like Brian and Adam to both assess and analyze risks from a physical risk perspective as well as a transition risk perspective associated with climate change. Then, once we've completed that analysis and have a really strong understanding of the landscape, taking that quantitative and at times qualitative data to develop comprehensive strategies to reduce and mitigate risk over time. And as Brian mentioned, protect asset value. This also extends to external reporting in line with external frameworks, which we'll talk a little bit more about later on today, so that these companies can speak with confidence to their investors or to their C-suite about the work that is being done to address this. Andrea touched on in her introduction the massive disruptor that climate change presents from a physical risk perspective to global real estate. Something like 17 insurance companies went bankrupt in 2023 alone. We don't anticipate these challenges to go away anytime soon. I live in West Palm Beach, Florida. It's no secret that insurers are pulling back coverage there on waterfront properties. We'll also talk more about transition risk later, but suffice for now to say that the regulations are evolving and in many jurisdictions increasing in number. So key point would be critical to understand and prepare to effectively manage this challenge.
Thanks, Emma. So with that, if we could maybe turn off thank you, and go into more of the moderated section of this webinar. And also a reminder for those who are listening, if you do have questions, please do put them into the Q&A section of the Zoom panel. So with this, I'll turn it over to Adam. So Adam, in the current market, do you see businesses focusing on physical risk or more transition risk?
Yes, both. So,
yes, and?
So from a physical risk perspective, yes, absolutely. We all understand that, the physical climate is changing. It has an impact on us as real estate investors, especially to the extent that we're seeking to provide long-term sustainable returns to our investors. How we manage through stormwater and flooding and hail and drought and water stress, the ability to actually access water in places like Phoenix. I think, look, within the context of the US, we're a pretty well-off country, and I think we can actually manage through most of this. But in terms of long-term impact to real estate, like, it is something we have to think about. To Emma's point, like beachfront property in Florida. At what point do you draw the line? I don't think we're at a point where an investment committee, we would say we're not going to buy this in most cases. I haven't yet seen that either at Hines or at JP Morgan. But it is something that is in our investment committee memos. It is something that actually gets talked about in investment committee. And I'd say if you look back 5 years, that was probably not true. And then I think from a transition risk perspective, that one's a little more difficult within the US because we take such a localized approach to it. So if you look across the Sun Belt, there's not as much interest in fines, taxes, whatever you want to call it in terms of energy or carbon footprint. But if you look at, we can all point to local law 97 in New York. You can look at Energize Denver, Berto. You can look at the new DC. And really, Energize Denver and DC, I think, provide the best, which is like, these can be pretty stiff fines. And the leases today, and I know those will change, like don't really allow those to be recovered from tenants, which means that hits your bottom line NOI. I saw fines of, up to 20% of NOI on one building. That's substantive enough where we will start taking action to decarbonize that building. And then lastly, I mean, this is less about fines and fees, but like you can look at California, where Brian and I are, and they take more of a stick approach than a carrot. Like Title 24 in the energy code here just dictates that you're going to do certain things you might not otherwise do, regarding heat pumps for HVAC or on-site solar, for new construction, things like that. So, the answer is yes, and we're looking at it across the entire portfolio, both transition and climate risk, from due diligence all the way through disposition.
And quick follow-up question for you, Adam. You mentioned at the investment committee stage of asset acquisition, I have seen a few of our clients look at underwriting and decarbonization or improvements to buildings as part of that acquisition process. Is that something that JP Morgan is looking at, or that's, you guys aren't tackling that quite yet?
I'd say in the capital planning process, we are. It's really hard from an investment committee process in many cases because the due diligence doesn't necessarily get you down to that level. And especially if you're trying to close in 30 days, like in many times due diligence just too fast. I think is the PCA providers, the Mark Jacobos of the world start coming up to speed on this, that would be hugely helpful. I just think, the decarb audits where you're combining kind of an ASHRAE 2 and electrification analysis, like that doesn't really happen in due diligence yet. And so we are looking at it from a capital planning perspective during budgeting season. We're taking all of our asset managers and investment officers down to the Building Energy Exchange in New York City in a few weeks so that they start getting their gears turning and thinking about this. But again, I think it's all there. It's upskilling people. It's getting this integrated into the process earlier on. But no, I'd say from a due diligence perspective, just it hasn't all come together into a nice package quite yet.
Emma, is that what you're seeing as well across our client portfolio, or what are some of the insights that you're seeing from our other clients?
Yeah, to answer the first question, it's interesting. The physical risk, you can access a free tool, right, and run a screen and take the results and say, look, I've done this assessment of physical risk. So I think the day-to-day questions that we get are more focused on transition risk, not to say that there isn't a need in the market to upskill all real estate professionals on what both of these mean. And to Adam's point, because transition risk is hyper local, even if okay, there's 40 jurisdictions with a building performance standard, that doesn't actually quantify for you what are the actual compliance fines associated with non-compliance with those standards. So these represent real impact to the bottom line. And I think just from my perspective sitting at RETEC, we are getting more frequent questions related to transition risk management. From the acquisitions assessment process, we do try to help our clients anticipate some of the anticipated fines associated if an asset under evaluation is in a building performance standard jurisdiction. We will help them quantify if the data is available to do so, historical utility data, for example. But yeah, it can be challenging during that 30 or so day window of time that the investment committee has to make a decision to underwrite all possible future costs associated with climate change. But we do try to provide what we can based on the data that's available.
Great, thank you. And maybe Emma, we'll stick with you for this next one. As we see more municipalities and regulatory bodies passing these mandatory sustainability or ESG requirements, both at the portfolio level as well as at the building level, whether it's in energy unit intensity or EY, carbon, or Energy Star, in your opinion, what will drive more of an impact? The portfolio or organizational level reporting requirements or the building level performance standards?
Really good question. It's a hard one. I don't know that I have a silver bullet response. I think both the portfolio level emissions disclosure laws as well as those asset level performance requirements can play a critical role in helping owners and operators define organizational strategy. They can also create new investment opportunities at both the fund level and the individual building level. So if we think about, from a reporting perspective, these portfolio level disclosures to mandatory frameworks, say European Union's SFDR, this is also a fundraising opportunity. We know investors are willing to pay a slight premium for targets that can demonstrate high levels of sustainability maturity that align with those investors' own sustainability goals. The other thing that I think is really interesting about these portfolio level reporting requirements is the impact that they can have internally on organizations in requiring new teams to connect in a way that they haven't before, right? So thinking of operations, accounting, asset management, controllers, these now are connected in some way to executive leadership to ensure comprehensive, robust responses to some of these reporting requirements. So a lot of times, just even asking the question, do we have this practice in place, can spur an internal discussion that can eventually down the line lead to the evolution and adoption of best practices. So I do see some important impacts at the organizational or portfolio level. At the individual building performance standard level, of course, these can help improve asset value. And what we're seeing is that it helps simplify decision making. So it's not uncommon for someone responsible for 200, 500 assets across a portfolio to have a little bit of analysis paralysis when they're trying to think about meeting the goals of the Paris Agreement and managing these assets in line with their responsibilities. So in a sense, some of these hyper-local building performance standards make it easier for owners to prioritize the assets that they want to address first. So if you're in New York City, you're subject to Local Law 97, probably might be a place to focus when you're considering investments in energy efficiency and protecting asset value. I think, of course, and Brian and Adam probably have more to say on this point, but it's critical to balance that fiduciary responsibility to their customers with these external reporting requirements. So no one's going to forego financial returns just to have a social or environmental impact, but the lens of building performance standard can underline or strengthen decision-making in some senses.
I think that's a really good point. And maybe we'll go to Brian from here. You know, you, in your opening statement, Brian, you talked about focusing on total return, and you're not looking at ESG funds, but you're looking at fiduciary responsibility for your fund. So what do you think with regards to portfolio or organizational versus building performance standards?
Sure. Yeah, the definition of fiduciary can take a lot of different meanings, right? You know, governance, good standards, good corporate citizen, all that. But to this question, in my opinion, it's building level performance standards should drive impact. You know, our goal has been and will continue to be to impact the communities in which we invest. If we, for example, if we buy RECs, we want to buy RECs in that community, not 3,000 miles away. So that simple answer to the question, you know, that's how we're viewing it. Not to say that portfolio level reporting isn't important. We think it is. UNPRI, GRES, SFDR, but it's a different purpose. And I'll deny if you repeat this, but I think it's for marketing purposes, right? Why are we
This isn't being recorded or anything.
No, not at all.
Okay.
So, no, you know, GRES, right? We're trying to compete with each other and get a better score. But it is driving, even though we're trying to get a better score, what it's doing is causing us to do good, which in the end is good for everyone. I get it. But it's for marketing. So it's a different impact on the portfolio level. And it provides transparency. So it's portfolio level reporting. It goes back to that governance comment that it gives transparency to our clients and to our various stakeholders.
Yeah, I'll quickly chime in. I agree with Brian. I mean, none of us do this because we like reporting, right? This is like, we like to run really efficient real estate because it brings down the cost for our tenants. We like to run high quality, resilient real estate because it enhances the value for our clients. A lot of it is marketing. We don't do GRES because we love doing lots of reporting and spending millions of dollars in our portfolio to do GRES. It's because we want to go say that we have a 5-star portfolio and pick up some extra capital on the fundraising side. I will say, I don't think any of us are particularly focused on ESG funds, but I think there is like a sustainable integration into the funds that wasn't there several years ago, or certainly wasn't well defined, wasn't part of our vocabulary when we were talking to investors. And the last thing I'll say actually from a reporting perspective is like climate risk is important enough from a risk factor that is becoming a critical part of our binding criteria as we uplift our funds for Article 8. So we will have our first Article 8 fund, and the binding criteria really is focused around mitigating climate and transition risks because it aligns with reducing insurance premiums, it aligns with more resilient real estate, it aligns with increasing value for investors. And I think as we explore that for our open-end Odyssey fund as well, like I think that's, to me, I'm hoping that makes an impact on the market, which is these are the ways we need to view this on behalf of our clients.
And we talked a lot about in 5 years ago, 7 years ago, these things didn't exist, or they weren't as robust, or they've evolved over time. This is a changing and evolving landscape of reporting requirements, and we've seen some integration, like SASB's integration. We've seen other things happening. We've seen SFDR and things in the EU change and push some of the US, and then vice versa. Anybody want to take a guess on with your crystal ball of where you see these reporting requirements going in the future? Maybe we'll start with Emma, because Emma kind of sees it across the landscape, and then Brian or Adam, if you have anything to chime in after.
Me to take the first guess. Definitely, I'm gonna point in the direction of continued harmonization, continued maturation, and the evolution of the reporting guidance. We've seen this, for example, with IFRS taking over governance of climate-related disclosures from building on the foundation that the task force for climate financial disclosures has provided to date. Under that IFRS climate-related disclosures standard, we've seen the criteria expanded. We've seen more granular metrics and best practices as one example. But I think generally the direction is a lot of frameworks or guidance starts out as voluntary. As they prove they can hold water, mandatory regulations, reporting requirements start to adopt and reference them. We saw that with IFRS, TCFD getting pulled into some reference materials for CSRD, European frameworks, even referenced in the SEC's contemplated climate disclosures. Similarly, another example is Energy Star, optional benchmarking tool that can be used for reporting, and some jurisdictions. Washington, D.C.'s building performance standard is now adopting that as one of their compliance pathways, making it in effect mandatory. So that I think will probably continue. Keen to hear how Brian and Adam respond.
Look, when set tight. So from a transition risk perspective, I sure hope that the various municipalities think about, you can't just say any building over 50,000 square feet. For example, Energize Denver, a multifamily garden style product with 25 different buildings that was built 35 years ago. How the heck are we going to make this net zero or meet the requirements in the next period of time? It's just not financially feasible. So I would hope at some point, and we know we live in a litigious society, someone's going to start suing these municipalities. They're going to rethink their regulations and hopefully give it more exemptions on these regulations for financial, or physical obsolescence kind of thing. So I hope that's where it goes. It's just going to take time.
Yeah, this is hard. We're going into an election year, right? We're in an election year. We're going into the election soon. I think the next 4 or 5 years, I think to Brian and Emma's point, you're going to see municipalities that care about this do some things. You're going to see a lot of the rest of the country not do much right now. You got to hope over the next 5 years that maybe there's more of a cultural shift and acknowledgement, just like what we're seeing in Europe, just like you're starting to see in Asia Pacific, really. So I think the next 5 years is going to be kind of this tangled web of like figuring out at a local level what we're going to do, whether that's Denver, Boston, Atlanta, Nashville. Like, is it benchmarking? Is it decarbonization? Is it energy code? So I think it's going to be more complex for the next 5 years, honestly. But you never know what's going to change, right? Like, I think we also all had these vague pandemic plans in place, and then 3 years ago we actually had to use them. And now all of a sudden you have very robust pandemic plans in place, and there's a good chance we probably don't need to use them for another 75 or 100 years. So, I think the next 5 years is actually going to be kind of tough and hyper localized in the US just because of where we are in the political climate.
No, that makes sense. Adam, let's stick with you. At a high level, how do you approach climate risk and reduce the risk at the organizational level?
So I mentioned earlier, like at the bank level, we buy lots and lots of different kinds of data from lots and lots of providers. We have our own in-house climate scientists, and they're creating various models to try to interpret all that data into something that's actually usable from a risk mitigation perspective. Within our portfolio, we leverage that. But I will say, it's very property specific. So if we have a property in Houston, let's say downtown Houston, do you have flood doors in the basement? Because Houston's connected by a tunnel system, right? So do you have flood doors? Are those maintained? Where's your HVAC located? Same for New York City. In California, you might be thinking about, air filters and, air quality and fire season. And I smelled smoke last week from one of the fires around LA. So it's going to be very specific to the particular location, the acute risk that it's susceptible to, and kind of what's in place at the building. And it gets even harder when I personally think it gets even harder when you get into like generally the living sector. So from high-rise multifamily all the way down to single family rental. So, I mean, whatever the models say, like you're really going to get your input from the folks at the local level managing that property and figuring out what you have to do, whether it's an engineering perspective, whether it's a disaster response planning. But that's really where it's going to go.
Brian, how does that get handled from your perspective at New York Life?
This question is about risk at the organization. I'll address
risk at the organizational level.
Yeah,
yes,
I'll address it from the asset level. So we do view climate risk throughout, I think as Adam mentioned earlier, throughout the life of an asset, under the guise of how can we improve resiliency of that asset. Yeah, we're seeing more and more DDQs and RFPs from consultants and clients asking about resiliency, more so than ever. So I can talk about this for the whole hour here, but it starts at acquisition. We get one of those, I won't say the firm name, but we get a report showing, all the colored boxes, whether it's green, blue, yellow, orange. And then that helps guide where our PCA gets focused on. And then RETEC obviously helps with potential mitigants. And then we use another firm to help us look at the value at risk each quarter within the particular fund. So we're able to input the AUM each quarter and see where we might have more exposure than another. And then in every acquisition, every disposition, we rerun that report to see what impact that transaction might have on the fund. I'll say a year or so ago at a conference, another institutional manager got up and spoke about this process and said there is an office building in a certain market that this fund had a certain exposure to, and the climate report came back with a red box on a certain risk, and they said we're not going to buy it because we're over a threshold. A different fund bought it in the firm, but that particular fund did not do it. And I give them credit for having thresholds. We're not there yet. We might be at some point. So these processes aren't yet creating value. It's more about risk management for our investors, which is again one of the errors in our fiduciary quiver that we have to focus on. Hopefully there's some impact on insurance rates in the future. We can keep wishing that, we have to keep an open mind in this process. For example, we're making an investment right now in South Carolina, and we went to go order that acquisition report, and they wanted $20,000. It should be $500 because there's multiple buildings in this large industrial park, and there's a creek nearby, and we said we're not doing it. Right? It's obnoxious. Other things we can do. So you got to have an open mind and be realistic in this process. Risk, transition risk. That's blowing up right now. RETEC has a really scary map, really informative, scary map that shows by Earth Day 2026, all the municipalities that have pledged to have some building performance standard in place. Again, depending who's sitting behind the Resolute desk come January, that map might change. I don't know. But it's something surely to focus on. And ultimately, we're not seeing exit cap rate adjustments or discussions around these risks impacting value. It might be coming soon, but it's not there yet. Similar to how we look at a property that in a 10-year cash flow model, we don't have a new roof budgeted in 10 years, but we know it needs to be outside the valuation. So if we go to sell it in 7 or 8 years, there needs to be some impact. So we do adjust the exit cap rate, let's say 25 basis points to account for that re-roofing outside our hold period. Why should climate risk cost be any different? Right. So I think we'll be seeing that here pretty soon.
Just real quickly, following on to what Brian said, I think the appraisal community hasn't started incorporating a lot of this into our just quarterly appraisal process.
Right.
I think we all have pretty robust appraisal processes, but just the appraisers haven't done it yet. And I'd say the same. Certainly, if the appraisers aren't doing it, certainly you're not seeing it from the sales brokers. Is as robust of a sustainability team as CB and JLL have, I don't really see their sales brokers incorporating it into the underwriting, the Argus models, and certainly not Eastdil either. So we're just not seeing it from the folks who we rely on to support our valuations.
Yeah, and just to add, I've seen the evolution of risk management and at that sort of intersection of sustainability. Back at a previous life when I was a global head of sustainability for a multinational firm, we used risk management and sustainability differently. And I've seen sort of this evolution of business strategy, well-placed use sustainability as part of that overall risk management. How do you reduce risk at the organizational level? If you have a supply chain, how do you look at reducing risk in that supply chain? Because if your supply chain goes down in a certain area, your business goes down. And so if you can look at the areas of risk, the assets that you have within the real estate portfolio of a company, and you see where those assets are a higher risk, I think it makes a lot of sense at an organizational level to take that sort of risk management lens and use that as part of your overall business strategy. And we have seen the businesses and the companies that do that actually have better returns, not only for a fiduciary return for their investors, but also stakeholder return, goodwill in terms of their either if it's a guest, if it's a hotel company, or if it's a consumer, if it's a consumer company. And so it's very interesting for me to sort of see this evolution of business strategy and business management incorporate, I think, smartly, holistic sustainability. And I think, Brian, you said it earlier, because you want to be good citizens and in the communities where you operate. Part of that is actually looking at what are the higher risk areas and assets within those communities and addressing those issues. Emma, did you have anything to add to this? If not, we'll move on.
I think she shared that scary map Brian was talking about.
I did. Hopefully we get a chance to share that with the panelists. I can speak at a really quickly. I think, Andrea, building on the point that you made about overlaying risk management, climate risk management into business strategy from the perspective of Legence. RETEC is a Blackstone portfolio company under Legence. And we are a relatively new company, rapidly evolving organization. We continue to acquire different business units to strengthen our position as the first energy transition accelerator. So I'll just say we are starting with the basics with every new business unit that comes on board: data collection, helping them understand reporting, RETEC quantifies Legence's emissions each year. And we've also taken the important step of establishing emissions reduction goals. I think the next frontier for us is to put more metrics, internal KPIs in place around climate risk management and what that looks like.
Thanks, Emma. Just a quick reminder to the audience, if you do have questions for our panelists, to please put them into the Q&A, and we'll leave, some time at the end. If not, I have lots of other questions if we don't have any burning questions from the audience. So Brian, earlier you talked about the tool that you use both on a quarterly and annual basis to look at assets, and you have the different squares, the red, the yellow, the green, the blue. There's so many physical risk analytics platforms out there. What is one thing in a physical risk platform that you look for, and maybe one feature that you feel like may convince you that a platform fits your needs versus another platform?
That's a good question. So we looked at some various firms a couple of years ago, and some were well more advanced than others, and probably more advanced than we were. And we probably honestly weren't far enough in our journey to use that resource. We hopefully will be soon. So we went with Moody's, their climate on demand tool, which is great. And that's what I referenced. We use to input our AUM every quarter and see what impacts there are. What I'd like to see is more, instead of the squares and probabilities, and to see actual insurance losses history in these markets with probabilities, and then we can take that probability against our AUM. I think that makes more sense. I think it's already out there. It's coming. I think we'll probably be there soon. I'm not sure where they get all their data from. I get it. It's NOAA, but you can probably run the same coordinates across 3 or 4 different providers and get different results. So I wish there'd be some consistency somewhere across these platforms. Yeah, so that's really what we're doing, and we're still evolving, and it's not, again, swaying our decision making, but just making us smarter in our underwriting, hopefully, and where to focus on in our underwriting.
I know Emma, RETEC uses several different tools and incorporates it into how we look at the asset level data. Can you talk a little bit about how we pull in those different information channels and with what we do with those?
Absolutely. Yeah. And I think credibility and the ability to interpret the results from these models loom large whenever we're screening a new vendor on behalf of our clients or even for our internal use. Our standard process as part of the physical risk support that we provide to our clients is to cross-check these screening results for a given asset or a given portfolio across 2 different platforms, because it's not uncommon for the results to vary by physical peril per property. One platform might indicate an asset has a high risk of flooding, whereas another might be low. Our team sort of dives deep, looks at additional resources, FEMA flood maps, etc., to make an informed decision, because these are models at the end of the day. They're not humans thinking and interpreting the results. So if there are unexplainable results, I think that's a clear indication that the tool maybe still has some opportunity to be refined. But just the fact that these are complex models, it's not uncommon also for them to be a little bit black box. You input an address in and you get one result out. We think it is important to do that additional due diligence to further our understanding of the true level of risk. The one other thing that I think is important just to mention from a screening perspective is customer service. So these are complex tools. If you aren't able to make heads or tails of the tool output, then as a sustainability professional, probably not going to have a ton of confidence to develop strategies to reduce the risks that you have uncovered. So I think that's probably a simple one, but it is critically important that speaks to the usability of these outputs.
Thanks. Adam?
Yeah, so I'll give a quick shout out. Most of you know Sven Beinert, who started CREM, but also has done like 10 other things in his career. Him and a couple of grad students recently released their analysis of couple dozen of these climate risk providers. I thought it was pretty good. If you can't find it and someone's interested, let me know. But again, wildly divergent. They basically ran the same properties through all the climate risk providers on the market and wildly divergent results. And they had a bunch of theories why and some thoughts on potential solutions. So, there's a guy now at JP Morgan who formerly at Morgan Stanley. They also had a white paper several years ago on just how divergent the results are. We were using 427 acquired by Moody's. We continue to use Moody's. And then via our partnership with RETEC, also use Munich Re's data. I think one of the big things that we look for is just companies that are vulnerable enough, I guess, to disclose the uncertainty of their results. So it's not just the data, but the uncertainty that surrounds that data from a statistical perspective. And Moody's is very good about that. There's a lot of folks on the market, and I feel like there's a lot of venture or growth kind of funding going into this industry right now. And so again, the next couple of years, it's going to get more tangled. But I will say, I also have the benefit of having climate scientists that I can rely on to say, yes, like these are the vendors we are really liking for reason X, Y, and Z. And I can say what kind of validated the decision with Moody's is that JP Morgan Chase, the parent company, will globally be using Moody's going forward. And so this is not meant to be a commercial for Moody's. There's other providers we looked at, and there's other ones that are really good. But for the next year or two, it's kind of Moody's all in, I think, on the JP Morgan front.
Yeah, I think, we've seen part of my role at RETEC is to do strategic partnerships, and we do look at vetting all sorts of vendors and platforms, and we have seen an increase in options out there, but we've also have seen some opportunities for some integration or some consolidation. I think anytime you have, and we've seen it with sustainability firms, and we've seen it with other SaaS platforms, right? You have something new, you have an influx, you have a lot of startups, you have a lot of things that are happening, and then you see consolidation, and you see the overall level of expertise rise through that. So I think we're sort of in that phase right now, I would say, with the physical risk and some of the platforms that we're seeing. And it will be interesting, I think, from a consumer standpoint, if I'm JP Morgan or New York's Life or RETEC, to be able to see what that landscape looks like, because ultimately transparency on where the data comes from, quality of the data, and being able to back it up with other platforms will show that we're actually getting the right data to the right asset at the right time to help everybody make the best decisions. So I think it's an interesting time right now. So I want to dive deep. We talked about organizational level, we talked about portfolio level, but at the end of the day, right, that doesn't move the needle on decarbonization. So Adam, maybe let's start with you. When evaluating energy efficiency, decarbonization, electrification, call it what you will, all of these different measures at the building level to implement, whether it's to achieve an energy reduction goal or a decarbonization goal or reduce the fines related to a building performance standard, whatever the reason, what are the factors that you look at most often in making that decision on a go, no go?
I mean, I won't speak for Brian, but I think he may agree. Like our goal is to provide the return we promise to our investors. And so when we look at anything in the property, whether it's sustainability related or any other capital program, you could think about this in the context of, do you go or no go on a new building lobby for a building that maybe was Class A and maybe isn't tomorrow? It's all about, can we justify this through the lens of our fiduciary obligations to our clients? So when we look at, I've yet to find an energy conservation measure that doesn't have a positive economic return. Now you have to figure out how many years or what IRR are you trying to hit.
Okay.
But I haven't seen one that does that. Electrification can be a little different. That's not always in the lens of efficiency. You can electrify and increase your operating expenses, and that
Right.
doesn't do great when you apply a cap rate to it. And then there's the renewable side, which again, if you're intelligent and thoughtful about it, you can have a good renewable strategy that will yield millions in potential NOI if you have the right portfolio. So for us, it will always be through the financial lens, and I think we're very open. Like, you're reducing potential fines, you're reducing OpEx, you're increasing tenant satisfaction because you're increasing tenant comfort in some way.
Mhm.
You're helping tenants meet, especially the corporate tenants, meet their own sustainability goals. I think all of that has to come together, but it's all because we're creating a return neutral or return positive experience for our clients.
I know, Brian, when we were doing the prep for this call, you said something was really interesting that I was hoping that you can dive a little bit deeper into. And when we looked historically at ECMs, the energy conservation measures, originally, right, when we did ASHRAE level audits, or we look at purely simple payback, that's not how you look at it today. Can you talk a little bit about how you look at these decisions?
Sure. Payback is one thing to look at, but we also look, we're in the business of creating value or preserving value. And part of that is, running valuation models every quarter and applying a cap rate to your NOI, right? Basic valuation process. Well, an ECM might have a long payback, but might have a good OpEx savings to it. So I call it dimes for dollars, right? So if we can cap $50,000 of annual savings at hopefully get back to our 5 cap days, then you're creating a lot of value on an exit. In some of our assets, we're not holding 20, 30 years. It could be more of a tactical play. So you're creating value through increased NOI, regardless of the payback on that ECM. And Adam made a good observation or comment about our tenancies. So we're seeing more and more tenants, office for sure, even industrial, ask us if we have a decarb strategy for that asset, because they have their own corporate responsibility goals and desires and reporting requirements. So they're coming to us and asking us. So again, it goes back to my elevator story earlier. You better have a story for your stakeholders, and your tenants are clearly your stakeholders. So it goes beyond, there's again a lot of reasons to do what we do, and our tenants are clearly one of them.
Emma, anything to add?
Not to that one. I think Adam. and
Okay.
Brian. Thank you.
Well, you guys are doing such a good job. We actually have no questions right now, so I have a couple more questions. But if we have audience questions, please do put them into the Q&A. I have a curveball question. The Federal Reserve just lowered interest rates 50 basis points, and I think we were expecting somewhere around between 25 and 50. It's the biggest reduction that we've seen in several years. With inflation sort of at that sort of 2 to 2.5% level, sort of where they're looking at it, when the Federal Reserve lowers the interest rates by 50 basis points, how does that affect, or does it affect at all, how you're looking at all of the physical risk and transition risk items that we've talked about? And does it influence you in part of your valuation of these different initiatives, like the ECMs or the other tenant initiatives that we've discussed?
Whopper of a question. Where's the softball at the end of the webinar?
Sorry, I said curveball. I didn't say softball.
Yeah. So I think our job is really hard the last couple of years. It's hard to go to folks saying, hey, let's spend some money because it's the right thing to do when NOIs are dropping, cap rates are increasing, and values are dropping 20, 30, 40%. It makes our job really hard. Yeah, interest rate cut of 50 basis points, which I think was the right move, not 25, because they should have done 25 last meeting. It's just going to start the process of values going back up, hopefully. Tenants willing to spend some money, capital's kind of cheaper, NOI goes up, then makes our job a little easier to start spending money at a property. Yeah, I'm not an economist. I don't play one on TV. It's hard for me to say, but it's the right move.
Yeah, I think look, how this will impact the discount rates for each property, and then we kind of look at that to say, does this energy efficiency measure make sense if you're aiming for a 6 or a 12? Like, it really depends on the investment strategy of that particular investment. Is it value add? Is it core plus, like development? Where, like, I think everyone's been traumatized enough the last couple of years where there's also the mentality of like, we're not just gonna spend. Like, we're not just loosening the purse string just because the Fed interest rate went down 50 basis points. And that's going to take time to trickle through anyway as we do refis and financings. So I don't think it's going to have a big impact necessarily on how we make our sustainability related capital planning decisions. Do I think that could help maybe the prop tech ESG market, and maybe like some of these companies can do a few more things? Like, we're talking with groups like Interdrape and Shark and some of these more innovative companies. Like, maybe it does help on that side where there's, they need the lower interest rates for more of the growth economy. But I think New York Life, JP Morgan, Blackstone, whoever it is, Hines, like, we're still going to be in the mentality of like, people aren't back to work yet in the office. So like, we're not going to go spend a whole bunch of money on office just for the sake of sustainability objectives. It's still going to be a financially focused decision first.
Emma, as you work with clients on decarbonization plans, how often does cost come up in terms of not being able to move the needle on physical changes at the building level?
All day, every day. I think that's always the first question that we're hearing, right? Which makes a lot of sense given what we've heard from our panelists. How much is this going to cost? What's my return? And then I think that begs the application of the lens of what is the actual strategy for this asset or this fund? Is it a long-term hold? Are we planning to dispose of the asset in the next 2 or 3 years? I think that also either narrows or expands the realm of opportunity when we think about capital investments to make efficiency upgrades. So yeah, it's top of mind in everything that we do. Remains to be seen the short-term impacts of the Federal Reserve lowering the interest rate as of this week.
And just one final question, bring back out those crystal balls. What do you see in the next 10 to 20 years, maybe 5 to 10 years might be more appropriate, around climate risk for commercial real estate? This could be maybe more standardization, more aggregation of platforms, a focus on driving action around risk. So what in sort of from your purview, from your lens, like, what's the one thing that you see happening over the next, call it 5 to 10 years? And we will start with Adam.
I think we're going to have a choppy few years. It's a pretty politically divisive country, and ESG seems to be front and center of that. It's kind of ironic with the anti-ESG stuff. To me, is kind of anti-capitalistic in a way that this is a risk that we need to manage through. And so to limit the ability to mitigate and adapt to risks is a little less free market than I would personally like. I think let the market speaks and see where it goes. And I'm willing to bet it would go more toward ESG on its own natural course, without influence from politicians one way or the other. I think as you get past the 5 years, you just have to hope the country comes back together in some way and is just less fractured. I also hope that we look back to technologies that are kind of like we know work in this space. Nuclear, from a power supply perspective, heat pump from a mechanical system perspective. These are tried, true, and tested. Like, we should be using these things. So I'm hoping the political will comes together to really kind of update energy codes and update the grid in a way that truly is resilient, without having to think the technology that will save us is 30 years out. I think it's all kind of here today.
Thanks, Adam. Brian?
I agree. Yeah. So I have no idea where it's going. Where was it 10 years ago, 20 years ago? It's nowhere. So what's my hope? thing I referenced earlier, common sense, right? Let's inject some common sense into this process, which I think it'll work itself out. It'll happen in the next few years, hopefully. I'll say one good sign is ULI this last, I guess it was spring in New York, there was a resiliency summit. It was a record attendance. So the industry's focused on it, which is a good sign. So that'll involve, evoke some change, hopefully, to what's happening now and bring consistency, changes, whatever, common sense to the process.
Great, thank you. Emma?
I'm going to go crystal ball, genie lamp, ideal future state for me is building on the increased interest in the education that's happening and then starting to standardize, I think, at minimum metrics that are used across commercial real estate industry to measure returns, the impact of these sustainability measures, both from a decarbonization as well as a resilience perspective. On the physical risk side specifically, would love to see more evidence from climate risk analytic providers that our customers have used our outputs and successfully reduced or negotiated alternative insurance premiums. So if they can start proving the impact of this analysis and the strategy development, I think that would make it a no-brainer for all of these companies to engage in this type of analysis. And then my hope, call it naive, is starting to see a little bit more consensus around what an appropriate building performance standard looks like across the jurisdictional or city level. I do think that other cities, as they come online, shall we say, are going to start looking at programs, peer programs that have been successful. Would be amazing if instead of one jurisdiction basing their performance requirements on Energy Star, another on energy use intensity, another on carbon use intensity, if there was a little bit of coalescing around an appropriate single metric. Of course, that would look different depending on EGRID region and climate zone, but I think a little more harmonization would make things much easier for RETEX clients for sure.
Great. Kira, if you could bring up that last slide for us, please. I just wanted to take 5 seconds and thank our amazing panel. So thank you, Adam, Brian, Emma, and for all of you for joining us. We really appreciate it. If you have any suggestions for webinars in the future, please, you can look at on the website, retechadvisors.com. There is an information and a contact us form, and we love your suggestions. Our next webinar in our series will be in November of this year. So thank you so much for your time and attention, and look forward to seeing you all soon at our next webinar.